Hello and welcome. You're watching a brand new edition of Policy Watch, where we analyze some of the biggest economic policy happenings of the past 1 week in India and around the world. I'm Ishan. And first up, our top focus. It's been a spate of negative news this last week on non-performing assets or bad loans of public sector banks. Now, NPAs of public sector banks have gone up over 23% in the last fiscal, prompting the RBI to say it would be especially watchful of bad loans. So here's a report on that.
Bad loans, loans disbursed that go unreturned. It's a malaise that's dogging public sector banks. Directly, bad loans affect the asset quality of banks. In the longer run, they strike at the roots of the economy. Banks do all they can to break out of the problem.
They are saddled with NPAs. Their usual recourse is to, engage with the company and see to it that the repayment starts as soon as possible. If that doesn't happen, then obviously the second recourse is that they try to go for a restructuring, debt restructuring.
Government data suggests public sector banks have acquired new bad loans of over 50,000 crore rupees in the last fiscal. NPAs of public sector banks have gone up from 216,000 crore to 267,000 crore rupees in 2014-15, crossing 5.43% of total advances of the banks for the first time in the last decade. Restructured assets of banks have also gone up from 7.17% to over 8% during the same period. Worryingly, the top 30 defaulters are corporate firms, accounting for nearly 1/3 of bad loans. Banking sector regulator Reserve Bank of India has expressed satisfaction on the quality of bank results for the last quarter, but it reiterated that it would keep a watch on NPAs of public sector banks, expressing concern on that front. Krishnanand Tripathi's report for Rajya Sabha Television.
And to help us understand, as far as the NPAs are concerned, the banking sector, its overall health, and how does that really correlate to the economy, we are joined by Priya Ranjan, senior journalist, and Renu, Kohli, former staff member at RBI and IMF. Thank you very much, both of you, for coming in. I'll start with you, Renu, Kohli. In terms of this news over the past 1 week that has happened, and the fact that NPAs are suddenly in focus right now, but this is a problem of the non-performing assets as far as the banking sector is concerned. That has been on for some time, and very little attention has been paid to it, hasn't it?
It requires, yes, it is a problem which is not surfaced now, and it has been building up. And the gravity is that even 2 years ago or last year, there were expectations that the slippages or fresh slippages into fresh NPLs would had peaked and they would decline, but they're actually accelerating. And this is a kind of an unprecedented situation. It hasn't happened before. As far as the diagnosis is concerned, it has been on the anvil for some time. It demands a resolution, and simply because from a macro perspective and from the perspective of lending and growth financing, because from a macroeconomic perspective, it has financial stability issues. The banks have to be sound and healthy, and if they're weak, then of course there is an aggregation of that creates systemic risks, which is not at all in the interest of macroeconomic stability. And from a point of view of being weak banks, it hinders and weakens their capacity to lend and finance growth. So from both accounts, it is something that ought to have been given policy attention, at least in the last 1 year, very, very focused way, which is to do with a recapitalization of the banks, whether they have to be, how to boost their capital, and from the point of view of resolution of bad loans, whether they should continue to be sitting and piling up on banks' balance sheet, or do the banks need to start afresh? It is not that there have been no initiative. There have been very many initiatives by the regulator, that is the Reserve Bank. In fact, very early on last year, the Reserve Bank did come out with a refinancing new refinancing rule which is popularly called the 525, because a large proportion of the loans happened to be in the infrastructure sector, and where there was a huge asset liability mismatch,
right.
Because typically infrastructure loans have a very long gestation period, whereas banks have a shorter duration of their deposit profile, which is the liability side. So, you know, there is a mismatch between 5 and 20 years, and that's exactly what this rule was designed to do, which is that those help the borrowers tide over a difficult downturn and give them enough time, elongate the maturity of their loans so that, you know, give them more time to realize when the cycle turns up, cash flows and revenue realization comes in, and thereafter there's a feedback effect upon the banks. But somehow there hasn't been enough of addressing or resolution of bad loans under the 525 rule. More recently, in June this year, the Reserve Bank also came out with something called a strategic debt restructuring mechanism, which actually empowers the lenders, which is the banks, to take over the promoters or the shareholders' equity, the debt portion into equity at a discount. They could always do so earlier, but there were SEBI rules which prevented them from taking at a discount.
Things are moving in a certain direction now, and things have, the RBI has taken measures, as you very explicitly spelled out over there. But Priya and Dash, I mean, I've been talking to you for about a year on this now, and NPAs is something you constantly talk about the fact that not enough attention was being paid to the fact and how that could impact overall economic growth of the country. So in terms of that, what would you say that is enough being done? Is it a priority issue? Of course, the RBI has stepped in, and the measures, as Ms. Renu Kohli mentioned, have been taken up.
Yes, I quite agree with Renu Kohli, but you see, essentially the issue is that there hasn't been a change in the business environment, and the investment cycle hasn't restarted. Although we've had 1 year of expectation that investment cycle should be restarting. Now, one reason why the investment cycle hasn't restarted is, of course, this trouble that the banks are in with their bad loans, and that large infrastructure projects, particularly as Renu Kohli was suggesting, are in trouble. But I believe that there is enough money in the system, which so there is no shortage of money for investment. But the investment is not happening because of other reasons, that it is not easy, or the demand conditions in the economy do not look attractive enough for investment cycle to kickstart. Now, that is something that was expected to be addressed policy-wise. Now, that has not happened. So, you do not have a policy environment which would kickstart investment.
But in terms of policy, I mean, the government has been doing a lot of initiatives and I'm seeing a lot of stuff, for example, from Make in India to Prime Minister Modi going across the world, asking for investments to, I mean, the fact that there was a slowdown, the government, at least in media-wise, seems to be doing a lot. But is that trickling down or is that not?
You see, fundamental problem is with demand. Now, can you imagine, as Renu Kohli was mentioning, that you do not have bias for power in a developing economy, which is, you know, which has to be, you know, is perennially power shortage. You do not have people buying power, for instance. You know, that the power that is ready to be generated cannot be produced because there are no buyers. Now that is a situation which sort of shows the demand conditions in the economy. Now, unless you address that, the entire cycle is not going to start.
The banking sector is also bears a part of that blame as far as the NPA problem is concerned. It's not just about the overall growth impacting the bank and therefore those assets are turning into non-performing ones.
You could say that, but you see, most of the projects, at least as far as the infrastructure was concerned, they were conceived and conceptualized, they were planned, the business plans were made at a time when all stories, including, you know, analysts, observers who are now singing a different tune altogether, all projections said that India's potential growth rate is this much and it will be growing at 8% plus until forever, and it was given like that. A, B, so obviously the demand projections were made at that time, but subject to that. So on both parts of the lenders and all, certainly there was a caution ought to have been exercised on the part of the banks that, look, are these projections over optimistic and should they not be more cautious? Because typically you will find that in such a euphoria or in a boom, you will find over-investment taking place, which is the case in India. All these over-investments were planned at that time. And then growth slipped, and the global economy itself slipped into a further. From 2012 onwards, if you've seen, global growth has not been above 3%, or it has been in the 3% nearabouts. World trade itself has been even lower, and it's less than half of their long-term trend. So the conditions turned adverse, and therefore these projects are no longer viable. And, you know, it's something which can happen. So in any
interest rates themselves
I
are
was
also
coming to that, yes.
partly responsible.
Yeah, there is a coincidence.
You know,
He's right. It's
when you have
the next part of the story
in a
is that.
regime of rising interest rates, NPAs are bound to go up. In a regime of falling interest rates, you are that much less likely to have NPAs. What has been happening is, in recent times, because of this fight with inflation, not only there has been a tremendous amount of demand squeeze that has been applied, but also interest rates have been jacked up. As a result, now of course that Reserve Bank of India in recent policies announcements has tried to turn it around, and now is softening because inflation has come down. But what has happened in recent years is that fight against inflation has meant keeping up interest rates, and the interest rates in turn, the rising interest rates have contributed to higher NPAs.
All right.
Now what has happened also is that when now that Reserve Bank of India has been signaling a softening of interest rates, the transmission of that signaling, that policy signaling, actually to the banks is not happening. Banks are not in a position to actually soften interest rate very much, because one reason is again the bad debts that they are carrying on their books. So it has become a vicious cycle.
Yes.
And the way to break out of this vicious cycle is to kickstart investment. And the expectation, as I was referring to you earlier, was that this process should have happened a year ago. There was a lot of expectation that it will happen, essentially by public sector investment. But unfortunately, that has not happened. Public sector investments haven't. They are loaded with money. You know, several of the Navaratna public sector companies, and they do have projects in the pipeline on the drawing board, which they are supposed to be implementing. They haven't. And in terms of government spending itself, there has been cut back. As a result, you know, so we haven't got what we are looking for.
All right. So as far as policy on this one is concerned, the government perhaps having to pull up its socks, and also the banking sector itself, and having to take a relook at this. We'll have to wrap up this section because we've absolutely run out of time. But Renu, Kohli, thank you very much for coming in and sharing your expert perspective with us on this one. Priya, Ranjan, I'll request you to stay on. We'll be discussing another issue. After the break, we'll talk about the stock market crisis that is gripping the world. The Chinese stock market tanked by over 8% on a Monday of this week. What's the meaning of that? How does that impact our stock markets and the global stock markets? We'll be talking about that on the other side of this break. Welcome back here with Policy Watch. Now on to our second focus story for this episode. The Chinese stock markets have been going through some massive churning in recent weeks. Fears of a slowdown in the Chinese economy have guided investor sentiment in a big way. For India, weak global sentiment coupled with the possibility of stricter investment norms for participatory notes or P-notes has also led to a sharp fall in the Indian stock markets. Here's more.
China it was that started the stock market tizzy, its benchmark index losing a staggering 8% in a single day. Slowdown worries shook investor confidence, and there are few signs of things easing out completely just yet.
What happens if the market falls another 10%? Will they come in with more support buying? Obviously, there's a lot of distortion now as the official buying is focused on the banks and the large cap SOEs, and smaller companies are showing much more volatile movements and haven't really recovered very much. So market signals are very muddy, and investors will remain nervous.
It wasn't long before the tremors reached India. The BSE Sensex lost 2% on Monday on global cues and concerns on strict regulation of investment through participatory or P notes. Observations made by the Supreme Court's panel on restrictions on participatory notes to check black money fueled worries further. The government stepped in to calm concerns.
The government would certainly not take any such action in a knee-jerk reaction, particularly one which has any adverse impact on the investment environment.
Authorities believe P notes can be misused to bring illicit money into the country, given that they need not be registered. They're popular with foreign funds for just that reason. Indian stocks have stabilized for now on GST reforms hopes, but there is a call for them kicking in soon. Krishnanand Tripaঠি's report for Rajya Sabha Television.
And we have with us in the studio senior journalist Priya and we're also joined by Sunil Kumar Sinha. He is the director at India Ratings and Research. Thank you both of you for coming in to discuss this issue. The Chinese economy is considered one of the economies that the globe looked up to, that the world looked up to. The economy now is going through a bad phase, and that perhaps is being reflected in the kind of the stock market crash that we saw on Monday, Mr. Sunil Sinha.
Well, I mean, this is only a reflection of a larger, churning that is happening in the Chinese economy. I mean, let's not forget that one of the major driver of Chinese economy was the global demand. And post-2008 global crisis, things have really not gone back to the level which was there before 2008. So in terms of global demand, which was one of the key driver of Chinese economy, China has been facing, a problem. I mean, although in the last, 5 or 6 years or since global crisis, they have tried to kind of shift the focus on generating or augmenting the slack in the global demand with the domestic demand. But they have only been partially successful. So to that extent, of course, I mean, devoid of any growth driver, a Chinese economy has certainly been facing the heat, and eventually now we are realizing that China is no longer able to grow at the double-digit growth that it had been.
It will be difficult to be the 7% growth rate at this.
So it is, I mean, year after year, its growth rate is falling. And there have been various kinds of stimulus given by the government to sustain the economy even at that level. So, I mean, all of that is somewhere finding its reflection in the stock market. I mean, not to forget that there is a bubble in the housing market of China that was also being talked about for a long, long time.
Global cues that the Chinese economy is sending out, and in terms of how that is shaping the outlook for the global economy, how would you define that?
In terms of the Indian economy too, which would outpace, because Chinese growth rates are falling, Indian growth rates, if growth rate accelerate, as is expected, then India would be able to take advantage of that. The meltdown of or the slowdown of the Chinese economy has already brought in benefits for the Indian economy in terms of the lower commodity prices, including energy, global energy prices, which are resulting in cost savings for our producers at home. And since we are not a major exporter to the Chinese market, we aren't really going to lose out much in terms of the Chinese slowdown. And what we see in terms of the other international market, export markets, is that our exports also have been falling for the last 7 months.
Yes.
But the Chinese exports have been falling faster. So what it means essentially is export demand for the Indian economy is bad, and the outlook doesn't look very good in near term. But in a comparative sense, Indian exports would
But that comparison doesn't help us in the sense that, I mean, we were talking about in the first half of this program that the investment cycle is not being kick-started.
The key to it, of course, is that, see, the driver of the Indian economy, unlike the driver of the Chinese economy, the driver of the Indian economy is the domestic demand.
Right.
Now, unfortunately, as we were discussing in the previous segment, we are not doing enough to change the demand squeeze that has happened in this economy. If demand conditions are turned around, and if India is able to achieve what it is expected of, then the Chinese slowdown is going to be turned out positive, and it will create a rather conducive atmosphere for India, including in terms of sourcing cheaper imports from out of China, which to my mind will be an advantage. Cheaper imports, not in terms of the consumer goods. I'm talking about in terms of capital goods,
right,
such as even power equipment and other such equipment, telecom equipment. And
all right, Mr. Sinha, we've spoken about the Chinese economy and the impact, as Mr. Dash was describing, on the Indian economy and how that could be beneficial for us. Would you agree with that point of view? And just sticking to the stock markets as of now, in terms of the cues that it sends to the stock markets over here, how do you think the stock markets would react to that? I mean, they've not reacted that positively, given the fact that we also had the P-notes issue that drove the markets down.
Well, certainly. I mean, you see, Chinese meltdown would have both positive and negative impact on the Indian economy. I mean, in the sense that we already heard the positive side of that the commodity prices are down, and the fact is that if we can take advantage of that and convert that into better manufacturing base for ourselves, obviously that is something which is positive. However, let's not forget that the Chinese economy is the second largest economy in the world, and it has a huge interlinkages with the rest of the world. And in fact, if you look at the current situation, then except probably US, where things appear to be somewhat improving, Europe, things are still in a turmoil. So, I mean, the three major economies of the world, if two of them are down and out, then obviously it will have a huge impact on the global demand. And that's what is getting reflected in the statistics. I mean, in fact, if you look at the global GDP growth and global trade growth, in fact, in the last 3 years, the global trade growth has been even lower than the global GDP growth.
All right.
And before that, if you look at maybe the last 10 years or so, then the global trade growth was almost double the global GDP growth, which simply means that in the last couple of years, the trade volume at the international level has come down substantially. I mean, part of the reason, of course, is the the global financial crisis, which has resulted in lower demand, and also some kind of a protectionist policies pursued by the developed economies. So if China starts melting down, then the scope of expanding the global trade, and in turn India benefiting from that, to that extent, goes down. However, the positive side is that since the commodity prices are down, I mean, you can be more cost competitive. So maybe, in some of the places or in some of the areas where earlier you were not able to export your goods, probably now you will be competitive and you can do that. So, but, to take the advantage of the Chinese meltdown, I think we still have a long a road to cover.
Priya, Ranjan, Dash, just moving on from here, in terms of the stock market itself, the fact that Mr. Sinha just mentioned about the Chinese stock market and the housing bubble that is about to burst over there, if I may use those terms, and that could have an adverse impact on that stock market, trickle down over here in terms of the investment of the money cycle. So as a whole global economy, are we heading towards a dangerous time? And given the fact that India, as you just said, is driven by domestic consumption, and that could be a little bit of a safeguard for us, is that enough of a safeguard? Because things like the stock market are completely interlinked.
They are interlinked, and but if the Chinese market is in a meltdown, it should, overall be positive for the Indian market, because as a competing emerging market, the fund managers would be looking at India, because money tends to flow where prospects for growth is better. So Indian markets could be benefiting, but if you want a more lasting benefit, then for that, of course, the Indian corporate profitability has to go up. At the moment, that's not happening. The companies are not showing better results to be actually able to attract funds. So companies have to show better results. And how would they show better results? Unless the business environment, especially demand conditions in the economy, turns around.
Mr. Sinha, final word to you, because there would be a lot of small investors who are invested in the Indian stock market also watching our show, and just a little bit of a prediction for them in terms of how the investment cycle or how the stock market could perhaps play out over the next couple of weeks, given the fact the global cues that are coming in are not that positive.
Well, certainly, global cues are important for the Indian stock market. That we have seen, time and again, that whenever global events occur, the impact is felt on the Indian stock market. Now, having said that, I mean, but also let's not forget that stock market also takes into account how the performance of the corporate sector is.
And stricter investment norms, like we know, it's not helping that?
At the moment, of course, the results that are out for the first quarter of this fiscal, I mean, the corporate results, they are not very encouraging. So, on the whole, maybe. But, you see, the basic point is that so far as the Indian economy is concerned, I mean, and the growth is concerned, I mean, the economy has already bottomed out. So, from here on, what one is going to see is a turnaround on an upside. Now, whether that turnaround is of a V shape or a U shape is a point of debate. My own view is that it's unlikely to be V-shaped, and that's what we have been seeing for the last couple of years. Okay. So it might take a little longer for Indian corporate sector to get back to the profitability that investors may be looking for. But if anyone who has a horizon of, say, 4 to 5 years shouldn't be worried so far as Indian stock market are concerned, because, I mean, given the strength of the Indian economy and given the way things have somewhat begun to move even at the policy level, my own sense is that 4 to 5 years of horizon will result in a fairly good, a prospect for any investor who has invested in the Indian stock market.
All right. On that note, we've absolutely run out of time. But, gentlemen, thank you very much for coming in, Mr. Dash and Mr. Sinha, for helping us understand these economic issues that we discuss in Policy Watch. Of course, as far as policy is concerned, so we've talked about NPAs today and the fact that a lot more needs to be done on that front as far as the Chinese stock market meltdown is concerned. There's an opportunity for India. Let's see who latches on to that. Thanks so much. That's all from us in Policy Watch. We'll be back next week with another episode.